This is ACC Amit Kumar and I'll discuss with you IAS 12 income taxes. The biggest confusion here is that we are accounting for income taxes. We are not here to compute income taxes. The moment we hear the term income taxes, our brain thinks that we need to compute income tax now. We are not required to compute income tax. We are simply here to account for income tax. And we compute or we account for income taxes according to accounting principles. So as long as we are accountants, will not be able to mix up things, because we mix up things when we shift being an accountant and being a tax consultant. So what we need to be, we need to remain an accountant. So if you understand a simple thing that we simply need to remain an accountant, we'll be able to clear most of the confusions. Don't try to be a tax consultant while dealing with IAS 12 income taxes. We simply need to be accountants. When we remain accountants, we are able to see what is the difference calculated by the tax consultant. Any difference between our calculation of taxes and their calculation of taxes results in deferred taxes. If we are willing to pay more, they are demanding less. If we have paid more and they are demanding less, that results in a deferred tax asset into our books that we paid more, though the tax authorities were not demanding it. We pay less tax today according to our accounting principles. The tax authorities are not demanding it today, but we know that they will be demanding it in future. We record a deferred tax liability into our books. I'll take you through it. In India, we have been using P&L approach. Tax expense is a combination of current tax and deferred tax. Tax expense is the amount we record in profit and loss account. Current tax is the amount of tax payable. The amount which is being demanded by tax authorities, this is the amount which goes into, I'm writing the word SOFP, statement of financial position, for the balance sheet. Now, according to our books, the tax expense is 54,000. But they demanded this year only 45,000 from us. What about the balance? Shall we ignore it and we also record 45 into our books? Because according to our accounting principles, the tax which we were supposed to pay was 54,000, but the counterparty, the tax authorities, only demanded 45,000 from us this year. Shall we ignore the fact and shall we record 45? Since they're demanding 45, we should also record an expense of 45. What shall we do? We will not get bothered with what they are calculating. We will stick to accounting. According to our accounting, we are required to pay tax of 54,000. We will follow accounting principles. We'll not get bothered with what is the computed tax. We'll account for the computed tax as part of our tax payable, that this is what we are required to pay this year. But we'll not forget that there is a difference of 9,000 and this will record as deferred tax. Now, what will it be recorded in this scenario? Will it be a deferred tax liability or deferred tax asset? We were willing to pay 54,000. They are demanding 45,000. We know that they'll be demanding this tax in future. When they'll be demanding this tax in future, Nitika, I repeat again. According to our accounting principles, we calculated tax expense of 54,000. We said that we need to pay 54,000, but they demanded only 45,000. They demanded only 45,000. Will they demand this 9,000 in future? Will they demand this 9,000 in future? Nitika, will they ignore it in future or will they demand it? If they demand it in future, Can I say that this is a liability of the future? And if this is a liability of the future, I should record it as deferred tax liability. When does liabilities arise? So there are two things to it. There are two kinds of differences. One is permanent difference and one is temporary differences. Permanent differences means not allowed deduction today will never be allowed in future. Or you can call it disallowable expenses. If there is a permanent difference, example can be entertainment expense. We took all the employees for a movie. This entertainment expense may form part of your profit and loss account as an expense. That is your accounting. But as far as income tax is concerned, according to them, this is not an allowable expense. They'll add back the income. Suppose we spend 50,000, so they'll add back 50,000 and will charge tax on it. So there's no chance of reducing this as part of income even in future. There's no chance of reducing this even in future. So permanent differences we record immediately. We include the tax payable related to them immediately because there is no chance of reversal in future. So if we have calculated tax expense of 65,000, but according to them, if tax payable is 72,000, we have no choice other than to increase this tax expense in P&L. We have no choice other than to increase the tax expense in P&L to 72,000. So we'll record a tax expense of 72,000. So the resultant entry will be, we'll record a tax expense of 72,000 and we are liable to pay 72,000. So this gets settled immediately. There's no accounting treatment to be followed or to be looked at again in future. Is this clear? This is how we treat permanent differences. Is this clear till now?
Amit, one question here.
Yes.
Why there will be a difference between tax expense and tax payable? Whatever we have calculated, should it be equal to the whatever tax authorities are demanding?
Will it always be equal?
It should be. If it is not, then what is the reason behind it?
The reason behind is the difference between accounting principles and tax principles. The reason is we included something as an expense into our books, but they did not allow it as an expense. According to your accounting principles, your profit and loss account, your presentation of financial statements may allow some expense to be included to calculate your profit. That entertainment expense is a welfare expense. This is required to boost the confidence of the employees. This is a mandatory expense which the company should incur, and this is going to give us benefit in future in terms of increase in revenue because employees will be motivated and they'll be doing some extra work and the company will be benefited at large. So the presentation of financial statements, the profit and loss account justifies that we can include this as part of our expenses. If the Companies Act, the statutory requirement or the accounting standard for dealing with expenses allows us that we can include entertainment expense as part of our expenses before computing our profit, before reaching our profit. But tax authority agree to it is not necessary. According to tax authorities, no, we will not allow this entertainment expense. You may have included it as part of your calculation of profit, but will not allow this as part of calculation of tax. So what if we have included 65,000 as an expense? So I've taken 7,000 difference because that 7,000 difference is the tax part on which tax is calculated.
Okay.
7,000 difference means that 7,000. Shall I take the new tax rate in India? 22 and after surcharge 25. This was a respite for companies, but I'll go with the previous one. 7,000 divided by 30 into 100. Suppose there was an entertainment expense of 23,333. Entertainment expense of 23,333. The same entertainment expense we included as part of our tax computation, and they said that no, will not allow any expense to be included as part of your computation. Zero. They said zero entertainment expense, disallowable. Will not allow it. Will not allow it to be deducted from your income. We will not allow this expense to be deducted from your income. So your income increases by how much amount? Income increases by an amount of 23,333, resulting in increase in tax liability at the rate of 30%. It is 30% of 23,333. So 7,000 increase in tax expense from 65 to 72.
Okay.
Cannot get better than this, I guess.
No, it's clear now. It's clear.
This was a permanent difference. Not allowed today, will never be allowed in future. We have no choice. We need to either so permanent differences rarely reduce our tax expense, they increase our tax expense. Next comes temporary difference. Temporary difference is a hope. Temporary differences are of two types. Taxable temporary differences, deductible temporary differences. Deductible temporary difference means you have recorded rent expense into your books as 40,000 into your accounting books. Into your accounting books, you recorded a tax expense, rent expense of 40,000. At the same time, you also recorded rent outstanding of 40,000 that you are yet to pay. Tax books say that we will only allow this expense to be included only when you pay. So according to them, rent expense is zero. But at the same time, they are saying that when you make the payment, that whenever you make the payment, if you're not making the payment this year, this happened in February, and you're making the payment next year, we'll allow this as a reduction in future. Means what? This is a deductible temporary difference. Deductible temporary difference means not allowed deduction today, but will be allowed deduction in future. Agree? They're not allowing this rent expense to be included as part of their tax computation. They are saying that no, will not allow this. So what it results in? It results in increase in income. If it results in increase in income, we are going to pay more tax this year. We are going to pay more tax this year, but we have a hope that when we make the payment in future, our tax liability is going to reduce in future. So what will it call? So temporary differences give rise to deferred tax assets or deferred tax liabilities. Why we are recording this deferred tax? To maintain our accounting fairly. Because if we do not record tax, if we do not record deferred tax, we'll never be able to know that we were not allowed deduction, and we need to have a claim for it. If we keep a record of our deferred taxes, we know that whether we have paid more taxes or whether we are still liable to pay more taxes in future. There will be two of the things: taxable temporary differences or deductible temporary difference. Here it was deductible temporary difference. Deductible temporary difference means not allowed deduction today but will be allowed deduction in future. This will give rise to deferred tax asset or deferred tax liability whenever it happens. Deductible temporary differences give rise to deferred tax assets or deferred tax liability. You're not allowed deduction today and will be allowed deduction in future. This is known as deductible temporary difference. This will result in an asset in future or liability in future. Assets, perfect, Natika. Deductible temporary differences always give rise to deferred tax assets. Because we pay more taxes today and we'll be getting a relaxation in future. If you paid more tax today, we can record it as DTA into our books. We can record it as DTA into our books. This 40,000 not allowed deduction. If the tax rate is 30%, how much tax payable? 30% of 40,000. Tax payable is 12,000. So in our tax expenses, according to us, there was no tax expense, zero. So the entire amount will go into deferred tax asset and tax expense 12,000, but we'll record a deferred tax asset at the same time. Because your tax expense is of two parts. Your current tax and your deferred tax. Current tax is what you're liable to pay. Deferred tax, you'll get a relaxation in future. So you'll record an asset immediately. So there is a debit here. Current tax 12,000, but there is a 12,000 of credit in the books in the form of assets. This will go into statement of financial position. This will go as part of your P&L. So your tax expense is a combination of the two. In your P&L, you'll show these two amounts and you'll show that zero tax expense for this item. Because there is no tax expense according to you. It is simply a temporary deductible difference, deductible temporary difference. So you will be paying, sorry, this is tax payable. 12,000 is the tax payable by you, and 12,000 will be recorded as part of your deferred tax assets as well. The balance is your debit equals credit, but there is no tax expense according to it because you are not liable to pay this. Tax expense is nil. So your accounting books are maintained. They have been successful in recording what you're liable to pay. They have at the same time been successful in recording that you'll get a relief for this in future when you make the payment. Is this clear? When you make the payment in future, in that year, there is no rent expense. When you make the payment in future, there is no rent expense. But tax authorities will include rent expense in future when you make payment. There is no rent expense. There is no rent outstanding because you made the payment. They will include rent expense of 40,000. Tax payable 0 this year. On this amount at least. Now this 12,000 which you recorded as an asset will be reversed this year now that you are not liable to pay tax on at least 40,000 of income. Because this increases your income in the sense that they reduced your income for the year, for the next year by 40,000 and will be computing tax only on the remaining amount. So they are not demanding tax on 40,000 of income. At least if they are not demanding on tax on 40,000 of income, means the tax which you have already paid automatically settles it. Agree? Hello? You paid tax higher already. This was a deductible temporary difference, means not allowed deduction today but will be allowed deduction in future. When you are allowed deduction in future, this results in a DTA, means you will not be liable to pay taxes in future since you have already paid higher tax today. Deductible temporary differences gave rise to DTA. Is this clear? Is this clear till now? Hello? Akash, Virpal, Hema, Uday, Pankaj, Sapna.
Yeah, clear.
And this line is also very clear. Deductible temporary differences give rise to deferred tax assets. Now comes chance of taxable temporary differences, means not taxed today but will be taxed in future. Not taxed today but will be taxed in future means what? Not taxed today means they're not charging tax today. But this is not a permanent difference. This is a temporary taxable difference, means they're not charging tax today, but they'll be charging tax in future. So shall we be prepared? Taxable temporary differences always give rise to deferred tax liabilities. There is a depreciation charge of 20,000 in our books, according to accounting books. Textbooks say that we'll allow you depreciation of 50,000 this year. Does it mean that they'll continue to allow this higher depreciation forever? No. What is it resulting in? This is a taxable temporary difference. They are allowing higher depreciation charge, means they are deducting 30,000 extra from the income. 30,000 extra from the income means they are not charging 30,000 extra from the income today, but they'll be charging in future. How much in future? Future liability. The rate is 30%, 30% of 30,000. They'll be charging more in future. Agree or not? According to us, we deducted an expense of 20. But they are allowing a deduction of 50 from the income. 50 from the income means our tax liability reduces by 9,000 today. Our tax liability reduces by 9,000 today means what? We'll be liable to pay this tax in future. If you are liable to pay this tax in future, we need to be prepared. What is that preparation known as? Tax expense. Current tax, deferred tax. Deferred tax will record 9,000, and if the current tax this year is, I'm just taking an imaginary figure, 34,000, we will record a tax expense of 34,000 plus 9,000. We'll not ignore this 9,000 which is to be paid in future. We'll say that our tax liability was 43,000, but since they did not demand 9,000 today, we should be prepared and we record a DTL today. Therefore, tax liability of 9,000 into our books. This current tax is tax payable. This is a deferred tax liability in the balance sheet, SOFP. We record both the amounts on the credit balance side of the balance sheet, payable as well as the total goes into as an expense in P&L, 43,000. We do not ignore this fact that they are not demanding 9,000 today. Will not record, if they are demanding only 34,000 from us, will not record a tax expense of 34,000 and be happy. We will continue to be an accountant, and accounting says that our tax expense for the year is 43,000. We are prepared to pay 43,000. If you demand 34,000 from us today, we'll pay 34,000 today. But we know that this is a taxable temporary difference. You're not taxing us today, but you will be demanding this tax in future. If you're going to demand this tax in future, we are prepared as an accountant and we'll be able to settle it from our DTL balance which we have created. What if we don't create this DTL balance? Our accounting will get confused because we'll be recording an expense of 34,000, and when this liability arises in future, we'll not be prepared for it. What is better? That we remain accountants. We do not get bothered with what they are doing, what they are allowing, what they're not allowing, what they're allowing as a deduction today, what they're not allowing as a deduction in future. What they're not allowing as a deduction today, but they'll be allowing it in future. They're not taxing something today, but they'll be taxing in future. So taxable temporary differences and deductible temporary differences, we need to account for in our accounting, and this is known as accounting for income taxes under IAS 12. This is what we need to do. We are simply here to account for income taxes. We are not here to compute income taxes. Is that clear? Hope most of the confusions are clear now. Atul, Nitika, Virpal.
Hello.
Yes, Uday.
One doubt. Actually, if suppose in tax books the depreciation is allowed 50,000, that means we will be saving tax, right? Because the income
will be saving tax temporarily. Temporarily, we will be saving tax. Means we are not demanded tax today. How much not demanded? 9,000 not demanded today. But they'll be demanding in future. Okay, let me show you. 1 second.
Okay.
Let me show you. Accounting books. Textbooks. We bought a machine for 100,000. Useful life 5 years. Using straight line method of depreciation, we are charging depreciation of 20,000 each year. The government says that we will allow accelerated depreciation. And allow it to be deducted in the first 2 years. So assume that profit before depreciation is 2 lakhs, and I'm assuming this is the same for textbooks. Just for the sake of ease, I'm assuming that this is the same for textbooks. The only difference they have this year is relating to depreciation. Depreciation charged by us 20,000, but depreciation charge, this is also known as tax depreciation. This is known as accounting depreciation. That is known as tax depreciation. How much is tax depreciation allowed in year 1 and year 2? How much tax depreciation allowed? How much tax depreciation allowed? They say that we'll give you relaxation and will allow you accelerated depreciation. You can charge 50,000 in year 1. Profit after depreciation is equal to so the profits are of lower amount because of higher depreciation. But according to our accounting books, our tax expense this year will be tax expense this year, if the rate of tax is 30%, tax expense this year will be 54,000. The tax payable according to tax authorities, it is 45,000. Profit after tax. What we are responsible for? We are responsible for accounting. We are not responsible for tax computation. Profit after tax according to us is 126,000. We should be bothered by this amount. This figure is from computation of tax. We'll be only interested in this amount. But we'll account for income taxes according to a tax expense. What will be the entry? Tax expense, debit 54,000. Current tax, which is tax payable, credit, how much? 45,000. This is current tax. What about the difference? What about the difference? We were supposed to pay tax of 54,000, but tax authorities demanded only 45,000 this year. What shall we do? Shall we be prepared for the difference? Shall we be prepared?
For tax liability.
Deferred tax liability. Now you're getting it. DTL, credit, 9,000. Shown as deferred tax in the balance sheet. SOFP. So tax expense is a combination of current tax and deferred tax, which will record in profit and loss account. And we'll stick to our accounting that our expense is 54,000. We'll stick to our accounting. This is year 1 accounting. Year 2. I believe the profit this next year is also same. Just for the sake of ease, I'm assuming the profit second year is also same. And second year also we were allowed depreciation of 50,000. Everything remaining same, but the deferred tax balance, which was standing at 9,000 in the balance sheet, has increased to 9,000 of the second year. The balance has reached to 18,000 in total. Agree? That first year we credited deferred tax liability of 9,000. Second year again we credited deferred tax liability of 9,000. So our deferred tax liability balance is 18,000. That will be liable to pay 18,000 of taxes in future, because first year we did not pay 9,000. Second year again we did not pay 9,000. Total how much we did not pay? We did not pay 18,000. Shall we be prepared to pay off 18,000 in future? Yes, we should. Third year. Third year, tax authorities said that since you have already consumed your entire depreciation charge, will not allow you any depreciation this year. But our accounting remains the same, because we have this asset for 5 years. So year 3 again, the accounting depreciation remains the same, no change. But what is the change? If you noticed, suddenly they were demanding 45,000, but suddenly they started demanding 60,000 of tax. So the tax payable increases by 60,000. will not get bothered by tax expense. Our tax expense remains 54,000. See, there is no change. Will not get bothered with what tax computers do. We will continue to maintain our accounting books, and our accounting books will continue to maintain an expense of 54,000 every year, because our income is same, our accounting depreciation is same. So we will continue to record an expense of 54,000 in P&L without any botheration. But we were prepared for this calamity in future. We knew that they're not taxing us today, but they'll be taxing us in future. So we were prepared for this liability by having an 18,000 balance in DTL. Now, this is an area which creates confusion sometimes in minds of people, that this should result in DTA. Why it is still a calculation with DTL? Because we already have a balance of DTL, it is going to reduce. Though this seems like a DTA, that it's a benefit to us now, that we are paying more tax. We are not paying more tax. It is a reversal of the previous tax which we did not pay. So just be careful while dealing with deferred taxes. The deferred taxes is present as a net amount in the balance sheet. So whether your DTA is reducing or whether DTA is reducing, one of the things will happen. The net balance is present in the balance sheet. We do not present two line items in the balance sheet. We do not present DTA separately and DTL separately. We present one line item in the balance sheet because it is with the same authority, and offsetting is allowed in this area. So in this example, it is not a DTA, it is actually reversal of a DTL. Getting the point? The DTL balance was 18,000. What will be the entry? We are required to be capable of paying 60,000 now. From where we'll get this extra 6,000? By debiting our DTL balance by 6,000. By debiting the DTL balance by 6,000. What is the balance left in DTL now? What is the balance left in? So in year 3, the depreciation charge is 0. Since we have already consumed 50,000 depreciation in year 1, 50,000 depreciation in year 2, according to textbooks. There's nothing left to be charged in the form of depreciation for this machine anymore. But our accounting books, we continue to charge depreciation 20,000, resulting in a tax expense on consistent basis 54,000. As I said, 54,000 is the tax expense in year 1. 54,000 is the tax expense in year 2. 54,000 will be the tax expense in year 3. Will not get bothered with what tax computation is. But in third year, if you notice, the current tax which was payable at a rate of 45,000 in year 1, 45,000 in year 2 has suddenly increased to 60,000 because there was nothing left for charging in the form of depreciation. So it was a taxable temporary difference, was not taxed today, will be taxed in future. Future is year 3, will be taxed in future. Are we prepared for it? Yes, we have a deferred tax liability balance of 18,000 to meet this additional liability of future. Deferred tax liability we have already been creating. So this year our tax expense is 54,000, but our tax payable is 60,000. How will meet this? From our DTL balance, we'll deduct 6,000. Our DTL balance will be left at 12,000 now, and 6,000 will be able to allocate for this additional liability which we are liable to pay. Is my accounting correct? Without being bothered and being successful in being an accountant. I'm not trying to be a tax consultant. I'm an accountant who is responsible for recording tax expense. If there is any difference with tax authorities, I'll record it either as DTA or DTL. Hema, hope that confusion is clear why there is a difference.
Yeah, so it is clear.
Year 3, this is accounting. What will be the accounting year 4 and year 5? Everything remaining the same. The only difference in year 4 and year 5 will be in the balance of year 4, in the balance of deferred tax liability. In year 4, the deferred tax liability balance will reduce to 6,000. Year 5, the deferred tax liability balance will reduce to 0. Agree? Birpal, hope this is clear. Akash? So deferred tax liability, which we built up over year 1 and year 2 from 9,000 to 18,000, has been reduced down to 12, 16, 0 and have been successful in doing our accounting well as also meeting our obligations of future.